The answer to why stocks randomly freak out every few months doesn't start in Washington. It starts in Tokyo. Japan, a country best known for anime, has also been the duct tape quietly holding the global financial system together for the past 30 years. And the most boring asset on earth, Japanese government bonds, is at the center of all of it. But to understand why Japan matters so much right now, you have to rewind to the early 1990s. In 1992, Japan's asset bubble burst. Real estate collapsed. Equities collapsed. Japan entered what became known as the lost decades. 3 decades of no real growth, no inflation, and no wage expansion. It was like the economy hit pause and nobody could find the remote. So the Bank of Japan did what central banks do when they're out of options. They cut rates to 0, and then below 0. And when that wasn't enough, they introduced something called yield curve control. For decades, Japanese government bonds yielded pretty much nothing. And that created a massive problem. Because imagine you're a Japanese life insurer or pension fund with $1 billion portfolio. Your domestic bonds are paying you 0%, which means you're left with 2 choices. 1, accept 0 return, or 2, go shopping overseas. Japan chose option 2. What followed was a multi-decade-long global shopping spree. Japan became the largest foreign holder of U.S. Treasuries, one of the largest buyers of U.S. mortgage-backed securities, and the world's largest net creditor nation, which is just the formal way of saying Japan became the world's ATM. And it's not because Japan loves sending money to America. It's because the math made sense. Here's how it worked. Meet Bob. Bob goes to the Japanese markets and borrows money in yen at near 0 interest rates. Then Bob converts that yen into dollars and buys U.S. Treasuries yielding 4%. After hedging costs and fees, Bob pockets the spread. That's the yen carry trade. And when your borrowing costs are near 0, you don't just buy treasuries. You buy tech stocks, real estate, and emerging markets. Basically, if it yields more than 0%, they'll buy it. At its peak, some banks estimated the yen carry trade at trillions of dollars. It was like the global markets were running on Japanese Wi-Fi. But the entire trade relied on one assumption, that Japanese yields would stay near 0 forever. And in 2024, that assumption broke. The Bank of Japan ended its yield curve control policy, and Japan raised interest rates for the first time in 17 years. Then they raised them again. And immediately following that second rate hike, the S&P 500 dropped 6%. Japan's Nikkei 225 plummeted over 12% in a single day. Its worst drop since 1987. It was a clear signal that markets were officially spooked. When Japanese yields rise, 2 things happen. Borrowing in yen becomes more expensive, and hedging currency risk becomes more expensive too. Suddenly, the free money trade isn't so free anymore. Bob's 4% U.S. Treasury doesn't look so good. This was the beginning of the end for the yen carry trade. The math had flipped. And when the math flips, the capital flows flip too. The money that flowed out of Japan for decades started returning home. This is called repatriation, and it's one of the biggest threats in global markets today. The cheapest source of global liquidity for the past 30 years is no longer cheap. And here's why that actually matters. Japan wasn't just a random buyer of U.S. debt. They were one of the most consistent, price-insensitive buyers of long-term treasuries on Earth. And here's where everyone is staring at the wrong lever. The Federal Reserve controls short-term rates, but the 10-year, 20-year, and 30-year yields, those are determined by supply and demand. Here's legendary investor Ray Dalio on exactly why this matters. Watch the bond market. The bond market is the backbone of all markets. It is the risk-free interest rate that determines what all asset returns are going to be. And when there is a breakdown in the supply-demand picture for bonds, you see a very specific type of market action. You see long-term rates rising relative to short rates. You see the currency go down. You see gold go up. Because there's a movement out of the bond market, a supply and demand imbalance. And when that happens, it raises interest rates and puts the Federal Reserve in a very tight bind. So while everyone is hyperanalyzing Jerome Powell's press conferences like it's a new GTA 6 trailer, They're looking at the wrong end of the yield curve. Because the US is running trillion-dollar deficits every single year. And even a slight reduction in demand matters enormously. The Treasury has to issue massive amounts of new debt every year just to keep the lights on. As that issuance keeps growing, someone has to absorb it. For decades, Japan was the key part of that absorption machine. But if Japan backs out, yields have to rise to attract new buyers. That's how you can get a situation where the Fed cuts short-term rates, but long-term yields stay elevated. That's what's called a steepening yield curve. And when long-term rates stop cooperating, it stops being just a bond story. It becomes an everything story. Because when analysts build models to value stocks, they discount future cash flows using long-term yields as the baseline. When long-term yields remain elevated, the present value of those future cash flows decreases, which means valuations compress. Stocks trade at lower multiples, even if earnings are perfectly fine. And that's why markets can suddenly feel unstable even when all the headlines look calm. Because the 10-year Treasury yield sets the price of money. It is the foundation of nearly every asset valuation. Mortgage rates are also largely anchored to long-term Treasury yields. So if the 10-year yield doesn't meaningfully fall, mortgage rates don't magically drift back to 3%. The Fed can cut the federal funds rate all they want. But if global demand for Treasuries weakens, the long end of the yield curve stays pinned. And when that happens, mortgage rates stay high. Housing affordability stays strained. Refinancing stays muted. And it's not just mortgages. Zoom out to corporate credit and it's the exact same story. When capital was cheap in 2020 and 2021, companies were issuing debt like it was Black Friday at 90% off. That's when we saw increased deal flow, higher valuations, and more activity across the board. Credit is the bloodstream of the corporate world. But if borrowing costs stay elevated, we see the opposite. Risk appetite falls. Growth slows. Capital tightens. And that's the main point. For 30 years, the United States benefited enormously from being on the receiving end of the world's largest carry trade. And now that trade is unwinding. What we are currently seeing is a tangible catalyst reshaping the foundation of the bond markets. And there's a reason why traditional financial media is ignoring this. It's because it's not clickable. It wouldn't trend on social media. Nobody wants to hear, let's discuss the cross-currency carry trade, because that requires patience, nuance, and more brain cells than doom scrolling allows for. Instead, people want inflation. They want AI. They want NVIDIA, the topics that are visible, loud, and create headlines. And so the narrative becomes oversimplified. The claim is, if the Fed cuts rates, financial conditions will automatically ease. That is not necessarily true. One rate cut does not fix everything. Liquidity is not automatic. And someone has to show up to buy the debt. But what if they don't? What if the largest foreign holder of US Treasuries decides to take a step back? Then you see global liquidity tighten. And liquidity is the oxygen in markets. And when the oxygen tightens, the cost of money changes everywhere. It affects stock valuations. It affects mortgage rates. It affects corporate credit, all at the same time. And that's exactly why the real threats in markets are never the loud ones. The loud threats are almost always already priced in by the time they make the headlines. The real threats are the ones hiding in plain sight. Quiet, gradual, and happening right now. The yen carry trade unwind is happening right now. Japan is quietly withdrawing from its role as the world's ATM. Bond markets are feeling it first. Long-term yields are behaving in ways that defy the traditional Fed playbook. And when bond markets shift, everything else follows. That's exactly why this channel exists, to shine a light on the issues that actually matter in financial markets. The issues that traditional financial media won't touch because they don't generate enough clicks. So here's the question you should be asking yourself. Are you watching the right lever? Because the duct tape is peeling, the Wi-Fi is cutting out, and the absorption machine is switching off. The foundation of global credit markets is shifting, quietly, gradually, and in plain sight. If you want to know what's actually happening in financial markets before it makes the headlines, hit subscribe. because I'll keep covering the things that traditional financial media won't. The quiet threats, the structural risks, the things hiding in plain sight, because the real threats in markets are never the loud ones. Those are usually already priced in. The real threats are the ones hiding in plain sight. Japan quietly stepping back from its role as the world's ATM. That's the real story right now. And the bond markets are giving you the first signal. If you know where to look. Stocks, mortgages, corporate credit, housing, it's all connected to the same thing. The price of money. And right now, long-term yields are telling you something. The question is whether you're paying attention. The oxygen is tightening. Slowly, gradually, but it is tightening. Brace for impact. The answer to why stocks freak out, why mortgage rates stay high, and why financial conditions feel tight despite Fed cuts. It all starts in Tokyo. The duct tape is peeling. And when it fully comes off, everyone will ask why nobody warned them. Watch the bond market. Watch long-term yields. Watch what Japan does next. And if you want to keep up with what's actually happening in global markets, hit subscribe and turn on notifications. Because traditional financial media won't cover this. It doesn't get clicks. It doesn't trend. But this is what actually matters. The structural shifts happening beneath the surface. Japan's role is changing. The yen carry trade is unwinding. And the ripple effects will reach every corner of global markets. When it hits, it won't be sudden. It won't be dramatic. It will be quiet, gradual, and everywhere at once. So pay attention to the right things. The bond market, long-term yields, Japan. Because the answer doesn't start in Washington. It starts in Tokyo. The quiet threats are always the most dangerous. And this one has been hiding in plain sight for years. Watch the bond market. It is the backbone of all markets. And right now, the backbone is under stress. Brace for impact.